joining us for today's webinar, a FinLab Snapshot on solutions to manage household cash flow. I'm Saurabh Kohli, an associate with the Center for Financial Services Innovation. I'll be leading the session today along with my colleague Ryan Falvey, the director of the Financial Solutions Lab. We are very pleased to have you join us today and welcome you all. To help kick things off, here's Colleen Briggs from JPMorgan Chase. Colleen is responsible for leading the firm's philanthropic and corporate responsibility strategy and financial capability, including the Financial Solutions Lab. So here's Colleen.
Thanks. So JPMorgan Chase is proud to support the Financial Solutions Lab managed by CFSI. As many of you know, more than half of Americans are struggling with financial insecurity. And so for JPMorgan Chase, we realized this was not only harming our customers, but also undermined the resiliency of our communities as well as the economy. And so we were really influenced when supporting the lab that, research showed people needed more than just better information. They need better, relevant information, but paired with a product designed around their needs. And we were particularly interested in the role of technology to help us better understand consumer needs and then create and scale financial products designed to address those needs. So the lab is really unique in that it brings together experts from across the field to help identify, enhance, and scale technology innovations to improve financial health. For JPMorgan Chase, we're interested in contributing more than just capital, so we are lending our expertise in financial services to help the winners accelerate their growth and maximize their impact. And we're also interested in using our global platform to help share insights with nonprofits, policymakers, and other stakeholders in the field. And we're particularly excited that this first competition focused on helping consumers manage their cash flow. JPMorgan Chase Institute recently launched a report focused on some of the challenges facing consumers, and we saw that there was extreme income and consumption volatility across the income spectrum, and that most consumers actually didn't have the buffer they needed to manage this volatility. So we were really excited that this first competition was focused on new innovations to tackle this challenge. And I think we were thrilled to see so many incredible innovations to help tackle this challenge. And so I'm excited to turn it over to CFSI, who's done a phenomenal job leading this, to share some of the insights from the first competition. And we're really interested to hear from you all as well to get your feedback on some of the trends that they saw through this first application process. So with that, I'll turn it back over to CFSI.
Fantastic. Thank you very much, Colleen. So here's a more detailed rundown of what we have planned for the session. First, I will provide an overview of the Financial Solutions Lab and the 2015 Innovation Challenge around household cash flow problems. Then, Ryan Falvey will present our observations from the application process for the Innovation Challenge. After Ryan explains the application response and the trends we identified, we'll have time to answer your questions. Throughout this session, raise any questions you may have for Ryan or Colleen using the GoToWebinar control panel, and we will address as many of these questions as we can during the Q&A portion. So let's jump into things. The Center for Financial Services Innovation's mission is to improve the financial health of Americans, especially those who are underserved. And we seek to do this by shaping a robust and innovative financial services marketplace with increased access higher quality products and practices. There are a few ways in which we are acting on this mission. Central to everything, CFSI leads a network of financial services innovators, which include large financial institutions, tech companies, regulators, entrepreneurs, and consumer advocates. We inform our network and the marketplace through consumer and market research, including our recent consumer financial health study, the work done by the U.S. Financial Diaries, and other thought leadership like our work with the Compass Principles, in which we seek to define and assess quality in the marketplace. We also advise our network and the outside marketplace through consulting engagements, and we seed innovation through mobile app competitions, nonprofit regranting, and now the Financial Solutions Lab. Financial Solutions Lab is a $30 million, 5-year initiative managed by CFSI with founding partner JPMorgan Chase Company. The purpose of this lab is to support entrepreneurs and innovators to develop and test technology-enabled, high-quality solutions that improve consumer financial health. With this initiative, we're identifying testing, and expanding the availability of promising innovations that help Americans increase savings, improve credit, and build assets. The lab is launching a series of innovation challenges which provide the best combination of incentives and resources for entrepreneurs, businesses, and nonprofits to enhance financial products and services that address these challenges and improve consumers' financial health. IDEO.org, who brings a human-centered design perspective to the table, and Ideas 42, who are experts in behavioral economics, are operational partners of the lab. Also, to provide support, we have a phenomenal cross-sector advisory council of high-profile senior leaders. To identify the topic and focus for the lab's first innovation challenge, we did a deep dive into pertinent financial challenges faced by low and moderate income consumers. Our proprietary thought leadership and market research showed us that income volatility is a significant problem that is challenging many Americans. Uncertain or volatile income and urgent expenses challenge households across the income spectrum. Nearly 1/3 of Americans encounter significant variation in their income, and over half of these Americans are employed full-time. The ups and downs, or spikes and dips in a household's income, do not always match the spikes and dips in expenses. Even though in a long-term view, for example, a year, overall income may exceed expenses, in between there can be moments or periods of friction when a household does not have enough liquid assets to cover due payments. This is a very difficult problem to manage. An effective way to deal with misaligned income and expenses is to establish a rainy day fund, but coupled with income and expense challenges, many Americans face a significant savings gap. In 2012, 45% of Americans did not save any portion of their income, and 61% of households did not have a rainy day fund to cover 3 months of expenses. With little savings, a majority of American households would not be able to cover a $400 emergency expense without selling something or borrowing money. With volatile income and an inadequate savings buffer, consumers often turn to credit to bridge the gap. A good credit rating and subsequent access to low-cost, high-quality credit saves the average borrower an estimated $250,000 over a lifetime in interest fees. However, more than half of American consumers have subprime credit. Consumers with limited or poor credit history lack access to traditional credit products like low-interest credit cards. As an alternative, these consumers turn to higher-cost products and services to manage their expenses. Because of a lack of access to higher quality credit, many consumers are relying on products that are not designed for their success. As a result, the challenge of household liquidity is complex and carries many costs. Some of those costs go well beyond the dollar amount. Continually prioritizing and making judgments on spending becomes a mentally exhausting exercise for households faced with challenges. These households must try to plan and predict their finances while confronting complicated decisions like how to access money and how to borrow and save simultaneously. With this innovation challenge, CFSI sought to find high-impact innovators, regardless of tax status, with in-market products that help solve household cash flow challenges. On this slide here, we show some of the solutions that we had in mind when coming up with this innovation challenge. We were looking to power solutions that may help low and moderate income consumers make better decisions to improve their savings habits and become more financially resilient, and to be prepared for a better future. We also saw innovations that expand access to financial services for consumers who are challenged in the current marketplace by extending financial services. The example here we have are that organizations that bring services such as banking or bill pay to new customers. And as I spoke to accessing credit before. From February 24th through April 7th, the Financial Solutions Lab opened its applications for the first innovation challenge around household cash flow problems. For applicants, the challenge offered an opportunity to participate in an eight-month program to help them build their products and businesses, to receive customized technical support, and to receive ongoing engagement with industry, regulators, entrepreneurs, and nonprofit stakeholders. The types of solutions that we were looking for were to benefit from resources beyond just monetary capital infusion. The resources offered by the lab include professional services, knowledge of financial services, networking, mentorship, and national partnership opportunities. Now, I will hand things off to my colleague, Ryan Falvey, who will share some of our learnings from launching the first Innovation Challenge. Ryan?
Thanks, Saurabh. So this section, we're going to kind of go through two major themes here. One, we'll provide you with some of the numbers behind the lab applicants to give you a little bit of context of who these applicants were, where they came from, what their businesses and organizations looked like right now when they applied. You know, there were people there that were part of them, how many people that were serving, where they were working. And then we'll dive into some of the observations that we saw from this pool of 298 applicants. First, you know, I think it's important to note that these applicants represent the work of about 2,000 employees. There's quite a few people who are working on these. The average team size was relatively small, 3 to 5 people, but considering the number of startups in there, I think it gives some indication that, and that's when you couple this with how much funding they've raised, which we'll see in the next page, that these are, you know, they're relatively, they're beyond the idea stage. Many of these companies have actual products in market. Certainly all the ones that we seriously considered that were accepted did. And I think that the combination of the number of employees indicates the degree of the sophistication of how these guys, these applicants were in their process. We saw applications from across the globe. We had about 27% of our pool was actually international applicants, although the majority of them came from the San Francisco Bay Area and New York City. We were really pleased with this, and I think it indicated the breadth of, indicated a broad applicant pool. We saw applicants from, you know, outside of the major kind of tech and finance hubs in the country, and I think also a reflection of a concerted effort we made here at CFSI to focus on kind of some of these other markets outside of these two areas. But to kind of bring you all into the mix here, we have a poll question. How many applicants do you think are currently being served by the 200? How many people do you think are being currently served by the 298 Financial Solutions Lab applicants? The options are 800, 6,000, 40,000, or 10 million. So use the poll feature and let us know. You've got 30 seconds. So I see about 3/4 of the people have voted. And while you're probably tempted to think that it was a relatively smaller, the actual amount was 10 million customers. 10,080,000 to be more precise. And these applicants, you can go to the next slide. These applicants are providing a number of products to their users. As we looked at that, we tried to kind of categorize like what do these solutions look like? What are people doing? So we use kind of traditional, you know, financial services buckets for those that, you know, we could easily define, and that was about 34% of them. So 34% of the applicants had kind of one major product. So starting from the top, so savings products. This is pretty, you know, obvious methods for reserving or accumulating money. It's a relatively small number, and part of that is because these products are quite complicated to build. Investing was the second one. These are asset-related products, maybe securities, retirement savings, homes, things that are really looking for longer life assets that the products help to build those. Payments, products that relate to transferring funds. So for the most part, remittance products went into that, just pure payment, P2P payment products, consumer-facing payment products fell into that category. Credit would be personal loans or income advances. We're going to dive into this one a little bit later in the webinar. Those are really interesting trends we saw in that. And then planning. So this is the traditional personal financial management tools, budgeting solutions, account aggregation and visualization services, and financial education solutions that kind of tended to focus on kind of the money you had now. So the traditional kind of PFM category. Again, another interesting topic that we'll kind of dive into in our closer observations. With the other tended to be, so below this kind of dotted line, you'll see the other category. So that was, pure education, training products, so financial literacy, coaching types of things. There were some accounting applications we saw, and some people helping prepare for their taxes, small business applications. So like those all kind of tend to fall into the other category. And finally, hybrid, which was by far our biggest, was an interesting one. And I think what we're really excited about. This is what we kind of defined as having two or more solutions together in a single consumer-facing product. Often what this meant is that the innovators behind these products were creating a solution that allowed that product to play a much more active role in a user's life. So an example of that is Even. It's a company from Oakland, California. They're actually a lab winner. We would have considered that to be a 3-product hybrid solution. Now this is just CFSI's approach. This is not how Even categorizes their product. They have an eloquent way of doing it themselves. But what they're doing is they're helping consumers save and advancing them funds to help them manage their finances. So what that means is the product has to have a way to safely store consumer funds, a savings product. It has to allow them to access those funds. So and in Even's case, they're actually advancing new funds if needed. So that we would kind of consider that to be a variation of a credit product, while helping them to understand and manage their money. Can that be a planning product? So we would have categorized Even as a 3-product hybrid. And if you look at some of the winners of the lab, so we get to the end, you'll see that a lot of them had that similarity where they really went beyond simply providing information to allowing you to kind of actively engage with your finances on your behalf. You can go to the next slide. I think that one of the observations from the pool that we were most excited about, CFSI, as Saurabh indicated in his introduction, we are a nonprofit. We're a mission-focused nonprofit on helping, and our mission is to help build financial health in the United States. And so to do that, we believe really strongly you need to actually measure what you're trying to do. And so of the applicants that applied to the lab, a large number, 48% of them were measuring some sort of social impact. And if you kind of think about, and so that's especially when we get into looking at this pool, these aren't just nonprofits, they're not just pure social enterprises. Many of them are just straight for-profit, venture-backed businesses, but they clearly view measuring their consumer outcomes as a really important part of their ability to grow their businesses. In many cases, they see it as a competitive advantage. So there's a function of this, of course, is that we are a nonprofit, so we probably got more of these than maybe other accelerators do. But I do think we think this is part of a broader kind of industry-wide trend to being much more focused on the financial health and the financial outcomes of your consumers, just kind of in the industry writ large. We also were actually generally pleased with how they were doing on impact. The chart to the left here, applicants by evaluator impact. This is a sample of about 100 of the 300 applicants in there, where we did a deeper dive into their product and really tried to say, like, is this really helping consumers? Is it improving their financial health? Do we think this product has a lot of impact? So we had a nice distribution of scores generally, but they did tend to skew higher. This was a 3-point scale. 3 would be a product that we felt had a tremendous amount of impact. 0 would be one that we didn't think had any. Those tended to get dropped out pretty quickly. But a 2 to 2.5 means that they're kind of ahead of the curve a bit on building products that are improving consumer financial health. 2.5 to 3 means they're very good, they're doing a good job doing it, and then 3 would be something that really had a beneficial impact on consumers. We can go to the next slide here. This gets into a little bit of the capital pool, where these companies were as far as capital they had raised, and then kind of the reasons for applying to the lab. The average amount across the 300 applicants was a little over $600,000 of capital. Cumulatively, these applicants had raised $178 million before they applied. There's some interesting kind of observations within that. While those averages are tended to be pretty consistent across the country, the amount of capital raised by organizations from the San Francisco Bay Area was significantly higher than other markets. Across all applicants, all 300 Bay Area-based organizations had raised an average of 71% more capital than organizations from outside the Bay Area. And of the 29 applicants that had raised $2 million or more than 40% of them were based in the Bay Area. We saw a significant difference in funding for pre-product companies. We had 81 of these companies, so these are companies where the product's still in beta, for the most part something that you couldn't download and use. Bay Area-based pre-product companies had raised more than double the amount of funding of those not located in the Bay Area, including New York City and Boston. The significant variation of capital between organizations based in the Bay Area and the rest of the country was noteworthy because the difference in the median number of customers was negligible. The team size was identical, about 4. And so while I don't think this would be a surprise to anybody who's in the finance or the venture capital community, it does serve, we found this to be a really interesting reason to be looking outside of the Bay Area at companies. There's a lot out there, and they're doing a lot of interesting stuff, and for the most part, if you're an investor, probably a better deal. So there's a lot to it, but something that we definitely want to draw people's attention to. The reasons for applying to lab, for the most part, were partnership opportunities. A number of people said capital, and that was important. If we were to break this table out and just look at those, the ones that were kind of our top applicants, I think it'd be even more skewed towards partnership and networking. People really saw those elements of the Financial Solutions Lab package as being kind of the most value additive for them, and so that was something that we were really pleased with. Certainly, it's what we consider to be really what helps to distinguish a lab in the market. Go ahead and flip to the next slide, sorry. So now I wanted to jump into kind of 4 of the key observations that we saw from the applicant pool. The first is this: we saw a trend from personal financial management to personal financial health. What this means is that if you think of like a mint.com, or there's a number of these products out there that allow you to kind of take information from your bank account, plan out your financial life, and get a better snapshot of where you are. We're seeing a big transition from that to products that take an active role. So maybe they pay your bills on your behalf. They might save for you. They might advance you capital when you need it. We really can consider that part of a broader industry trend from personal financial management to personal financial health, and I think as we get into some of the numbers behind that, I'll help to bear that trend out. 2, we saw the nature of credit is evolving. There's a lot here, and so we'll get into it in the next slide, but we saw a number of applicants who were advancing consumers' funds using, often cases, age-old models, but use technology to do it in a new way, or who had leveraged technology to find kind of new ways to advance capital of people to really to kind of plug gaps in the market. The third big trend we saw is that, and this was really a trend, this is just an observation, that prepaid infrastructure is far more frequently utilized to build products, to use products, than cryptocurrencies in the blockchain. This is just, again, very, very early in the life cycle of crypto. But we would have expected to see a little bit more than we did. And finally, there's a kind of certainly there's a trend for companies to try to reach their consumers through their paychecks. And so this could be, going through existing employers, looking at the 1099 economy. But we saw a lot going down that path, and it's something that we really want to kind of call out as we got through it. But first, let's talk a little bit about like from personal financial management to personal financial health. When we looked at our applicant pool, I said at the beginning, 14% of our applicants had planning-only products, so that they, it's just you log in, you link up an account, and they help you understand, and those products help you to understand what's going on in your financial life. Maybe they give you tips, but they don't actually engage with your account. 38% of products had kind of what we consider to be a hybrid planning product. So they coupled that functionality with something else. So it could have been credit, it could have been savings, it could have been bill payments. Those companies that coupled those two together had 16 times the average number of users than those that only had a planning-based product. So it's a significant, almost an exponential difference between, just putting a product out there that helps people understand their finances to one that allows them to actually helps to take action on their behalf. They had to raise 6 times as much capital, so that means they were able to acquire those users much more capitally efficiently than those that were using planning-only products. And although we had a 34% average team size, it's worth noting that the average team size of the entire applicant pool is 4 people. So you're talking about an extra person basically. So we saw this trend, especially the increase in the number of users, as being really significant, kind of foreshadowing. I don't want to say like necessarily the kind of the death of PFM products, but really the next iteration of it is a product that becomes much more active in your life cycle. Certainly, one of the companies that won the lab challenge, Prism, is a great example of this. It's you can log in, it helps you manage your bills, but then Prism actually gives you the functionality to go in and it will pay your bills on your behalf for you, tells you what bills you should prioritize, and really kind of helps you understand what your expense situation looks like in a given moment in a way that would probably not be possible if they didn't actually have that ability to interact with your finances. The next major trend that we wanted to draw people's attention to was the changing nature of credit. This wasn't a huge number of applicants. I think we had kind of 10 that we could 10% of our pool had was just pure credit models, and there was a number of the hybrid ones that had a credit functionality to it. But across them all, they were all very sophisticated in their approach. There were very few we didn't see any products that didn't have something in market, didn't have a really well thought out structure and approach, didn't have a comprehensive understanding of the legal basis to which to offer these products. These tend to be pretty sophisticated products generally, and we've identified 7 kind of major categories that we saw in the applicant. The two that were ROSCAs and OSCAs. A ROSCA, is a rotating savings and credit association, versus an OSCA, which is an accumulating savings and credit association. These are models that have been around forever. They exist in most cultures around the world. A ROSCA, for example, 6 members, just the notional amount, would contribute a set amount once a month, and each month a different member of the ROSCA receives a lump payment. Mission Asset Fund in San Francisco is a great example of this. There's eMoney Pool, which is a for-profit startup that also does something like this. But what we're doing here is you're using technology to basically try to kind of scale this out and be able to serve a lot more users than would otherwise be possible in kind of a traditional kind of just kind of peer or social group model. An OSCA is a little bit different than a ROSCA in one crucial way. All the members put in money up front, and then they can kind of take it back and take it out and pay it back on an as-needed basis. Puddle, a lab winner, is a great example of an OSCA. they're using technology, they're using their ability to kind of tap into your social networks to create some virility on how people are able to join the pool or the puddle, and then using the trust that they build with each other to help them kind of monitor paybacks and compliance with the rules of the OSCO. Another model that we saw, which was very early on, was an income share agreement. These have been used in student loans. Where if you get a student loan, you agree to pay back a certain percentage of your income for a set period of time. Again, this is a model that exists in other markets. It's not quite that common in the United States, but we do see some developments in this space. It's one we're watching very closely. You saw a number of interesting ideas on P2P lending. Now, this is a space that people have a tendency to think is well developed. You kind of put like a lending club or a Prosper into this space. We saw a lot more that were, the way that those models we kind of have tended to work at scale, and might be the way the industry breaks down, is the people providing the capital tend to be larger institutions, and people taking it out tend to be more on the person side. We saw a number of models that were straight person-to-person lending. There's a company called Ledge out of Los Angeles that essentially just keeps track of IOUs and promissory notes between people, and leverages Venmo to facilitate the payments. So that would be a great example, just a pure P2P lending model. So we see there's a tremendous amount of innovation that's still happening in that space. It's exciting, and we're watching closely. We saw some really interesting approaches on credit builder loans. For those of us in kind of this is a space that the nonprofit has been very active in for a long time. And one I think is really important. We're now seeing some for-profit companies come in and really looking at how they can do this at scale. I think probably the most notable one in the company in the credit builder space is called Self-Lender out of Austin, Texas. You just sign up with Self-Lender, and they give you basically a synthetic secured credit card, and you can use that to build credit as you go through it. We have a company in the portfolio, one of our winners, Lend Street, has this functionality built into its product. So they've set their debt settlement product up so that as people go through the process, they're able to rebuild their credit, which is one of their kind of primary differentiators from them and other and kind of how the market works right now. So there's a lot of innovation happening in the credit building side. There's a lot more companies looking at the space, and I think hopefully we see that as generally a really good thing for consumers. There's another kind of growth in kind of affordable overdraft lines, guaranteed overdraft, where you kind of make an agreement and they'll advance you money as you need it. There's a company called Float out of Los Angeles that's trying to building this product. They're still pretty early in their life cycles, but they'll allow you to kind of advance funds as you need them. There's some other developments in the pool that got us excited too on this one. So as payments are able to speed up, as the awareness of companies of consumers' financial status increases, you're increasingly seeing the ability of innovators to kind of quickly advance a consumer the funds they need to avoid an overdraft, really on this kind of short-term liquidity piece of it. And that's related to the last, which I saw would be income smoothing. Again, we saw a number of very innovative approaches for income smoothing. Even, as I mentioned before, would be a great example of this. A company called PayActive and Active Hours are both doing things in income smoothing by allowing you to access your paycheck earlier than you otherwise would. So that's money you've already earned. They're just able to give you it before you get to payday. So these are products that are really focused on liquidity. They're not intended to be kind of long-term credit. And I think if you ask any of these companies in this space writ large, are you a credit product? Probably all of them would say no. So it's one reason we're really looking very closely at this and continuing to watch it. I mean, obviously, this is a space that if it continues to grow, could have have a lot of potential for helping consumers, and of course, there's always the potential for products to come along that aren't helpful. So it's one thing that an area that CFSI is paying very close attention to. The third trend, let's spend a little bit of time on, is just the growth. Let's say it's maybe the growth, because prepaid's been around for a long time. Just going to be the durability of prepaid, and kind of it looks like the next iteration of prepaid card infrastructure to allow innovators to build really interesting products that, for the most part, resemble bank accounts. So virtual bank accounts. We had 21 virtual account products. Moven is an example of a virtual account product. Simple was one before they were required last year, where you can, for your purposes as a consumer, it looks like a bank account. There's a company called Walleteros out of Miami that focuses on Spanish-speaking consumers. But so they're able to provide a really customized service, often one that's targeted at a niche or relatively, or not even relatively small, oftentimes groups that have been excluded from the formal banking sector so far. So you see a lot focused on different ethnic groups, a lot focused on younger consumers. But these products are oftentimes built on prepaid card infrastructure that runs in the background. And so what looks to a consumer as a checking account, FDIC insured, it allows you to pay bills, it allows you to make deposits, is oftentimes a pooled prepaid product in the back end. So you're allowing companies then to go to market with very interesting solutions much more quickly. Of those 21 products, I'd say the vast majority of them were launched in the last 2 years. It's also prepaid card infrastructure is allowing innovators to develop savings products. We see remittance products based on this, where you're using prepaid cards to really dramatically cut down the cost of remittances between countries. And of course, we're seeing a lot of bill pay activity there. So I think this is one place where we had 19 companies that had kind of prepaid card products, but then we also had a number more that were using prepaid cards and you just didn't see it. And for the most part, that might even be undercounting, because we only had the information of the application. Blockchain and cryptocurrencies generally. The use cases we saw continue to really be around wallets, exchange models, and remittances. We do see some and I think personally this is probably a function that it's very difficult to build consumer-facing Bitcoin products with a domestic use case. If you look at that space right now, it's increasingly focused on the blockchain and thinking about how to use the ledger to keep track of contracts and different types of negotiable instruments. I would have personally expected to see a little bit more though on the consumer side than we did. That again, this could just be a reflection of this is pretty early in Bitcoin and crypto. So I think I wouldn't say that this is a negative indictment of the space at all, but certainly we'd like to see more innovation in this area focused on consumers and see kind of what's possible. But it was an interesting observation at this point to see just the stark difference between how the infrastructure of these two products, these two different types of products is being leveraged by innovators. And then the last major observation that we wanted to draw attention to were like that many organizations, both for the for-profit and not-for-profit side, are really seeing the consumer's paycheck as the path to the consumer. So there were kind of three major buckets of solutions that we saw. One were products that were connecting directly to the payroll providers. So where you were able to when you're getting your paycheck to sign up for it. Maybe it makes decisions for you depending on where it puts your funds, setting aside funding. A company called Double Net Pay out of Atlanta is a great example of this. They integrate directly with ADP, the big payroll provider, and allow you, and basically they scan your accounts and look at like what's really kind of variable, what your variable expenses are they set aside your fixed expenses, your mortgage payments, your utilities, and then allow you to basically manage your variable expenses on a monthly basis. It's a great solution, but we saw a number that were kind of worked through the payroll providers. Saw a huge number that are trying to sell to and through the employer. So most people who work have an employer, and the idea being, like, if I can go and talk to McDonald's or a Walmart and get them to offer this to their customers, then I can try to acquire those millions of potential users at a lower cost. This has proven to be extremely difficult in the past. It's hard oftentimes to build really big scale businesses based on partnerships. But it's not, certainly not to say that it's not possible. But this was one that we saw. Looking at distribution strategy is probably the most common. And then finally, we saw a small number. 4 companies were really focused on addressing the needs of the 1099 economy. So these are those people who work and don't have employers. There's been a lot of focus on this in the media over the last several months. A lot of that focus tends to be on kind of sharing economy-based companies. The vast majority of people who have a 1099 or a freelancer or independent contractor are not working for Uber or Instacart. The vast majority of them tend to be in more conventional jobs. And if you've ever received a 1099, just to back up, a 1099 is the form you get if you're an independent contractor versus a W-2 if you're an employee. A contractor, the employer or the company that's paying you doesn't have an obligation to withhold payroll taxes. You oftentimes aren't getting any benefits. And so you have a greater tax burden. There tends to be other associated costs with it. If you're making a lot of money, you have some obligation to pay taxes more frequently than you otherwise do. So we saw a number of companies that were really trying to solve that problem. Fluid out of Los Angeles is really focused on contractors and professional services firms. They call Painless 1099 out of Richmond, Virginia. That's really focused on that kind of the new 1099 economy. So maybe some people in the sharing economy, or who might have kind of shifted to this role, who aren't yet aware of kind of the tax ramifications of that, and really can they help planning and managing their financial status because of that. So finally, with our last couple of minutes, I just want to highlight who actually won the challenges here. This is our first class of 9 companies. And now that you can see a little bit of the trends, I hope it makes a little more sense of why we selected many of these. Digit is an automated savings tool with a really very elegant kind of text-based communication interface. Even, I mentioned before, it's a smooth income by helping you save in good weeks and advancing it to you in not great weeks. Propel is an application that makes it easier for people to apply for and manage food stamps, so really opening up new income sources to consumers and taking a really painful process and making it easy. Ascend Consumer Finance is a credit product that's designed to incentivize positive financial behavior. So if they have an elegant way of looking for consumers whose credit score might not tell the whole story about their financial situation. Maybe they're better credit risk than any other the market might think, and they reward you for actually kind of proving them right. I mentioned LendStreet. It's a debt resettlement platform that really helps consumers build credit while recovering from a charge-off. Prism is a bill payment application I mentioned earlier. Pagel, going to kind of that workplace scene. This was a nonprofit associated with Neighborhood Trust, which is a nonprofit credit union in New York City. Pagel is already with employers, so if there's anyone who knows how to crack the employer code, that we think that the nonprofit space might have a lot to add there. If you think about that distribution of users, those 10 million people that applied to the lab, a lot of them were working with nonprofits. Nonprofits have an amazing ability to scale users, and they serve a lot of people often. So they're looking for technology to solve it, and Pagel is one that is an approach that we think is pretty interesting. I mentioned Puddle. It's virtual Rosca that leverages kind of community, that builds community and and trust through that community to ensure repayment. And then finally, support pay, which we didn't mention, the payment platform for divorced couples or separated couples to manage shared financial obligations. This is one that we saw, kind of going to a space that many people who might not be in a situation or might not be aware of, but separated couples have oftentimes decades of financial obligations to each other that they need to manage and plan for. Support pay really sits in that and helps take the pain out of that transaction for a lot of people. So with that, I think we're at the end of our formal presentation, and we'll open it up to questions. So I'll hand it back to Saurabh to moderate.
Alrighty, great. Thank you very much, Ryan. So we have a bunch of questions, so I'll just start firing those to you. First, how representative would you say this applicant pool is of the greater fintech emerging?
I would say it's not representative. So if we look at fintech, there's thousands of companies in it. They're all over the world. They're solving problems, all sorts of different industries. We're looking for consumer-facing solutions here. So if you're looking at fintech for U.S.-based consumers, particularly low and moderate income consumers, I think this is probably a pretty representative cross sample. We did a lot of work to try to identify these entities before we set out on this, before we open up the application process and tell them about what we're doing. And of the 50 or so companies that we really made an effort to target, all of them pretty much applied. So I think if you're looking at consumer-based financial services, this is probably a pretty good snapshot.
Very good. And do you feel that most of these applicants were focused on LMI consumers, or were they mainstream products with a great potential for LMI consumers?
We actually kind of categorized, especially once we got kind of further along in our application process, we try to separate out those two. So some of them are mainstream products that I think are probably, none of these products are looking for kind of high net worth individuals, wealthy people. That's kind of, if you could say upper income on beyond, we didn't see much of that. We did see a lot of companies that just would say, hey, I'm serving everybody. And there, what we really try to look for are which of these companies has a strategic interest in reaching out to low and moderate income consumers, and we're going to be able to help advance that. And I would say that probably was the minority of applicants. I think the majority were pretty focused explicitly on kind of the low to moderate income group. Some function of that was because a lot of them were targeting, different ethnic or minority groups. Another function would be who might, as a whole, not be as wealthy as kind of the median wealth in the country, and then younger consumers who tended to be have less money as well.
Okay. Here's a more technical question, or requires a little bit more of an explanation. When you were talking about how prepaid infrastructure is caught on more than the blockchain, could you provide more of an explanation of what the blockchain is?
Sure. So if people think about Bitcoin, which is a virtual cryptocurrency, so you can exchange Bitcoin, like you can hold Bitcoin. So think of Bitcoin as as a dollar, right? The blockchain is essentially the underlying database technology that keeps track of who has which Bitcoins where. So it's basically a database technology, but unlike kind of existing other database technologies, which maybe think of Excel, maybe they store things in columns and rows, and your program looks for it and finds the data you need. What the blockchain is doing is relying on kind of a network of computers who are going to be verifying together and kind of reaching a decision about who has what by consensus. So it makes for a very secure database, and it also makes for one that can operate can keep track of a lot of information extremely well. So I'm sure there's someone who's there's like a Bitcoin person who's just totally turning over with anger and frustration at that explanation, but basically that's it.
Great. Here's another somewhat technical question. You mentioned advancement models like even and active hours. Do you know if these are free of fees for consumers, or how else are they monetizing their product?
So a number of them take different approaches. I think just the ones that those two specifically. Even charges a subscription-based fee for their product, and active hours, essentially it's up to the consumer. So it's kind of like a tip. So you can kind of give active hours whatever you think that was worth to you at that moment. So if you don't think it's worth anything, you don't have to tip them. If you think, I don't know off the top of my head what their average. I wouldn't know that information, but it's basically optional as a consumer.
Here's a more general question. Are there any areas in particular where you're seeing significant room for growth or significant room for consumer impact?
I mean, all of these, the whole space, right? I think it's great that there was such a deep pool of applicants here, and I think the companies that we selected are really promising and are doing some really interesting stuff. This is a problem, though, that when we looked at the household, as you kind of elaborated the introduction, this affects 100 million Americans. So let's assume that these companies are doing a great job in solving the problem. They've only solved it for 10% of the addressable market, and so this is a huge issue. And I think that what this kind of competition has exposed, that there's really a continuing need for additional solutions. So, going back to that slide, products that help people save, that help them build credit, to access the kind of affordable credit that they need when they need it, help them better plan their financial lives, to make there's a whole host of solutions. One area that I think that you could look at this challenge and say, well, hey, the problem is that people just need more money, and that's probably true. And I think that one of the reasons that we were really keen on Propel and Support Pay is by solving a problem, they're actually getting people more money. And so I think there's a lot of opportunity to actually solve that income problem by looking at what's behind it. And if you can find a way to get people more money for using your product, it's going to create some pretty viral adoption. So I think there's a lot of opportunity out there.
Okay. Here's a question more specific to the applicant. Did you see a diversity of founders or entrepreneurs who were applying to the lab?
Well, I think we actually didn't, unfortunately, and I think this is a learning for next year. We didn't track, we didn't ask people about their race or ethnicity during the application process. So we don't necessarily know. We don't know how we did on that front. I would assume we probably didn't do that well. Just because I think there's clearly a lack of diversity within the technology industry writ large. I think there's and so I think we probably did okay compared to that kind of sorry benchmark, but we probably generally need to do a lot better. And so I think in future years we'll try to track that and at least see if we're at least trying to reach the right types of people. I think when you take the male or female side of things, we did okay. Of the applicants, 31% of them had a female founder. That was skewed a little bit by the not-for-profit community. We had I think 68 nonprofits that applied for the lab. There was better representation amongst that group, although not great. The for-profit applicants, we had 25% who had a female founder. So that's higher, I think, than probably industry averages by a relatively significant degree. But I also think that we probably could still do a lot to find those types of entrepreneurs. One of the things that we did find last year is that if you look for people, you tend to find them. So we made a big effort last year trying to get applications from across the country. I will still continue to do that, but I think when we have future challenges, we'll be making much more of a concerted effort to reach out to some of the underrepresented groups in this country and see if we can get them to apply. At least know that we are out there.
Alrighty, so I think we have time for 2 quick questions. I'll make the first a little faster. Are there any areas that you think are particularly challenging from a regulatory perspective?
That was your easy question. It seems like credit products. I think credit and savings both are very difficult. They did require a degree of sophistication to even get a product in market that does not exist in other spaces. So those would be the 2 that kind of jumped ahead.
Okay, and we've received a few different questions around this. Basically, folks are wondering what's next for the lab. Do you have an idea of what the next challenge is going to be?
So we have an idea what the next challenge is going to be. We haven't made any decisions yet, so we're kind of narrowing down the process. I think I can tell you that we'll keep basic elements of this structure in place next year. So we'll identify a problem that we think is affecting a large number of Americans that is has potential to create really significant businesses or organizations to solve, and we'll probably be announcing what the specific topic will be, in the next couple of months. We'll look for products that are broad though, and I think that I think that's really important. This one was household liquidity, but you see we had a pretty broad final pool that we selected. I think the basic parameters will be the same. We'll be looking for a product that helps consumers. It'll be focused on the U.S. We'll look for things that are addressing, that are solving problems that millions of people are facing, that they're spending billions of dollars to try to solve. And so I think that if you have a consumer-facing product, you should reach out to us and at least let us know you're there, so we can keep you in the loop. I know that you can go to the website and sign up for the mailing list. It's pretty easy to find any member of the team on the website, but we'd be happy to talk to you and kind of keep you appraised as we go through the process.
Alrighty, fantastic. Thank you very much, Ryan, for answering those questions, and Colleen, thank you for your kickoff earlier. We really appreciate everyone's attendance on this, and we hope that you stay in touch with the Financial Solutions Lab with the hashtags FinLab and FinHealth. Please stay in touch. So thank you very much.